This is Meet Sean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
What if I told you that signing a so-called fixed-rate mortgage doesn't actually guarantee your monthly payment will stay the same?
Yeah, that is definitely not a myth.
Right. I mean, a year from now, you could open your mail and find out your monthly bill has jumped by, hundreds of dollars, just completely out of nowhere.
It's the ultimate nasty surprise for new homeowners. And honestly, it happens every single day. People just panic.
Oh, I would totally panic.
Right. They think the bank made a massive mistake. Or worse, they think they're being scammed.
And that panic is exactly what we're going to eliminate today. Welcome to the Deep Dive. Our mission today is to essentially step into the shoes of a seasoned realtor, giving you the ultimate first-time homebuyer briefing.
Yes, the inside scoop.
Exactly. Imagine you're sitting across the desk from us. You've got your coffee, you've got your notepad, and you are ready to completely demystify the journey of buying and owning a home. Okay, let's unpack this.
Let's do it.
We've got a fantastic stack of source material today from Sean Carter, LLC. It's a pair of really comprehensive real estate and mortgage guides.
They are incredibly detailed.
They really are. One of them focuses heavily on how to leverage a seasonal windfall, specifically your tax refund, to get you into a house. And the other dives deep into the notoriously misunderstood world of escrow accounts, homeowners insurance, and why those monthly payments suddenly spike.
Because knowledge is most valuable when it is actually understood and applied. I mean, when you're talking about making the biggest purchase of your entire life, you can't afford to just nod along.
Yeah, just smiling and signing things.
Exactly. You can't just sign 50 pages of documents and pretend you understand what's happening in the background. We need to strip away all the industry jargon and focus purely on your long-term financial stability.
So let's start at the very beginning of that journey. Before you can even scroll through property listings online or, start arguing over paint colors in the kitchen, you have to prove you actually belong on the playing field.
You have to prove your financial stability to a lender.
Right. And let's be honest, looking at the sources, they lay out the baseline paperwork required to even get a pre-approval, and it feels incredibly invasive.
Oh, I hear that a lot from first-time buyers.
Yeah.
It really does feel like an invasion of privacy.
It's just so much documentation.
It is, but think about it from the lender's perspective. They are about to hand you hundreds of thousands of dollars. They need a high-definition, 360-degree view of your financial health.
Which means pulling everything together.
Right. They need your passport or driver's license to prove you are who you say you are. They need comprehensive statements from literally every bank and investment account you hold. And they need absolute proof of ongoing income.
So handing over the W-2 forms and the most recent pay stubs.
Exactly. It's a mountain of paperwork.
It really is. But the sources introduce a really fascinating strategic angle here regarding the timing of all this. A lot of people get a significant sum of money back from the IRS in the spring.
You do, yeah.
And coincidentally, spring is the busiest, most fiercely competitive season in the real estate market. The guide suggests that a tax refund can drastically alter your savings strategy for a home purchase, provided you document it perfectly.
That timing is a massive advantage. I mean, if you get a $5,000 or $10,000 return, that's a sudden influx of cash that can push you over the finish line.
Oh, for sure.
But there is a very strict rule the sources outline here, and it's called funds seasoning.
Right. And when I first read about funds seasoning, I was genuinely baffled by it.
It confuses a lot of people.
Basically, the rule is that you can't just get a $10,000 tax refund from the IRS on a Tuesday, deposit it into your checking account on a Wednesday, and then use it to buy a house on a Thursday.
No, absolutely not. Lenders want to see that money sitting idle in your account seasoning, as they call it, for at least 60 days.
Wait, if it's my money and it literally came from the government, why does the lender care how long I've had it? It feels like having to show a bouncer at a club, not just my ID, but a biography of how I acquired my ID?
That's a great way to put it. But if we connect this to the bigger picture, the lender's caution makes perfect sense. Lenders are fundamentally in the business of assessing risk.
Okay, fair enough.
When a massive sudden deposit shows up in your checking account right before you apply for a mortgage, alarm bells just immediately go off for the underwriter.
Hold on, let's define that real quick. The underwriter is who, exactly?
The underwriter is the actual person at the lending institution who acts as a financial detective.
A financial detective. Got it.
Yeah, their whole job is to review your life, crunch the numbers, and officially approve or deny your loan. They are the ultimate gatekeeper.
So they see this 10 grand drop into the account.
Right, and their immediate thought isn't, oh, good for them, they saved up. Their immediate thought is, did this person just borrow 10 grand from a wealthy friend to fake a down payment?
Wow. Okay.
Because if you did, that means you secretly have a massive undisclosed debt hanging over your head. It completely throws off your entire debt-to-income ratio, which makes you a much higher risk for defaulting on the mortgage.
Ah, okay. That makes a lot of sense. So the 60-day seasoning period is basically an anti-fraud measure. It proves the money isn't just a secret short-term loan.
Exactly that. It proves stability. And because underwriters are so incredibly thorough, the documentation required for this specific tax refund strategy is super rigid.
So you can't just tell them it's from the IRS.
No, you can't just say, oh, it was my tax return. You must keep a copy of your actual filed tax return. And you have to keep the specific deposit receipt from your bank showing that exact amount clearing.
Wow.
You are essentially creating an airtight, highly transparent narrative for that underwriter so they don't second-guess your financial integrity.
Which brings up a huge flashing warning sign the sources have for first-time buyers. Whatever you do, do not take that tax refund and blow it on a depreciating asset right before applying for a mortgage.
Yes, please don't do that.
Do not go buy a new car to celebrate your upcoming house hunt. Do not buy a boat. The sources are adamant. If you want a mortgage approval, you have to fiercely protect those seasoned funds until your realtor and your lender explicitly tell you the deal is totally done.
It's all about preserving your financial profile exactly as the underwriters saw it when they pre-approved you. Because once those funds are seasoned, the bank is happy, and you actually find the house you want, you're going to need every single dollar for what comes next.
Right. So let's say your refund is perfectly documented and seasoned. You've diligently saved up your down payment. You think you're ready to get the keys. But the sources point out this is exactly where most buyers get completely blindsided by the hidden hurdles of real estate.
Yeah, let's talk real numbers here, starting with the down payment itself, because there are a lot of myths floating around.
Like needing 20%.
Exactly. You don't necessarily need 20% down. The sources break down the actual percentages. If you're getting a conventional mortgage, you're typically looking at a requirement of anywhere from 5 to 20% of the purchase price.
Okay.
But for an FHA loan, which is hugely popular with first-time buyers because it's way more forgiving on credit scores, the requirement is only 3.5%.
That's a huge difference.
It is. And if you're a veteran qualifying for a VA mortgage, the requirement drops to somewhere between 0 and 3.5%.
Okay, so most people generally know about saving for a down payment. They budget for it for years. But the absolute shock comes from what the sources call closing costs. They define these as the hidden fees of home buying. And the financial reality check here is honestly brutal.
It really is.
The guides note that closing costs typically range from 2 to 5% of the home's total purchase price.
It is a staggering amount of cash that people just simply forget to account for in their spreadsheets.
I'm reading this, and honestly, it sounds exactly like buying concert tickets online. You know what I mean?
Oh, yeah. The extra fees.
Right. You see the price of the house, you think, great, I can afford that.
Yeah.
You are thrilled. You get to the metaphorical checkout screen at the closing table, and suddenly there is a massive convenience fee tacked on at the end.
It really does feel like that.
For a typical $300,000 home, 2 to 5% means you have to bring an extra $6,000 to $15,000 in cash to the closing table. Where is a normal first-time buyer supposed to randomly find an extra 15 grand on closing day?
I completely understand why it feels like a scammy convenience fee, but think about what's actually happening in the background to make a real estate transaction legal and secure.
Okay.
Those closing costs aren't just arbitrary markups. They pay for a massive infrastructure of professionals.
Such as, who are we paying here?
Well, you have the loan origination fee, for starters. That's the fee the lender charges for the actual labor of creating, processing, and underwriting the loan itself. Then you have the appraiser. The bank requires a licensed professional to go out and verify that the home is actually worth $300,000, so they aren't accidentally lending a fortune on a shack that's literally falling apart.
That makes sense.
Then you have title insurance, which requires researchers to scour public records to ensure no long-lost relative of the seller can suddenly show up in 5 years and legally claim they own the land you're living on.
Oh, wow. Yeah, you definitely want that.
Exactly. And then you have the escrow setup fees to get your property taxes and insurance accounts running.
Okay, so when you break it down like that, the fees do make logical sense. But finding that massive chunk of cash at the last second is still the number one reason deals fall apart right at the finish line.
And this is the core strategic advice in the guides. They highly recommend using your season tax refund specifically to cover these closing costs.
Ah, okay.
Because let's play out the alternative. You saved your down payment, but you completely forgot about the closing costs. Your only other option to save the deal is usually draining your personal emergency savings.
Wiping out your emergency fund on day one of homeownership sounds like a recipe for an immediate panic attack.
It's the worst possible time to have zero financial liquidity. I mean, you just bought a house. What if the furnace dies the week you move in?
True.
By deploying your tax refund directly toward those closing costs, you leave your emergency fund totally intact.
Yeah.
You set a realistic budget using a mortgage calculator, you plan for those hidden costs up front, and you basically avoid that horrible late-stage panic entirely.
All right, so you've navigated the closing table, you paid the down payment, you used your refund for the closing costs, you got the keys, and you finally moved in. You have your monthly budget completely dialed in.
It's a great feeling.
It is. You're sitting on your couch a year later, feeling great. And then, out of nowhere, you get a letter from your lender saying your monthly mortgage payment is going up.
The dreaded letter.
Here's where it gets really interesting, because I'm looking at this from the perspective of an outraged homeowner going, wait a minute, I signed a fixed-rate mortgage. How on earth can my payment go up if my interest rate is locked in stone?
What's fascinating here is the absolute disconnect between the cost of the actual loan and the ongoing cost of the property itself.
Okay, explain that.
When you sign a fixed-rate mortgage, the principal and the interest, meaning the money paying off the actual physical house and the profit going to the bank, that stays fixed forever.
Yeah.
It literally never changes.
Right.
But your total monthly payment to the bank includes more than just the loan repayment. It includes the escrow account.
So let's define this clearly, because the sources dedicate a ton of time to unpacking this. An escrow account is essentially a special holding tank managed by your lender.
Yes, exactly.
You pay into it every single month, and the lender holds onto that money and then uses it to pay your annual property taxes and your homeowner's insurance premiums on your behalf.
And let's be very blunt about the dynamic here. The bank sets up an escrow account because they fundamentally do not trust you.
Wait, they don't trust me to pay my own bills?
They don't trust you to save up for massive lump sum annual bills, no. Because think about the risk to them.
Okay.
If you fail to pay your local property taxes, the local government can put a tax lien on the house and eventually seize it. The bank loses their collateral.
Oh, wow.
And if the house burns down and you let your homeowner's insurance lapse because you didn't have the cash to renew the policy, the bank's collateral is literally reduced to ashes. So, the lender forces you to save by collecting those funds monthly to ensure those vital bills are always paid on time.
The ruthless logic of the banking system at work. Okay, the math behind this is pretty straightforward, at least at the beginning. The sources explain how they calculate your monthly escrow charge.
Right, it's an estimate.
Yeah, the lender essentially guesses your yearly tax and insurance costs based on the current rates. Let's say they look at the local tax records and estimate your property taxes will be $3,600 for the coming year.
Okay.
And they estimate your insurance premium will be $1,200. That's $4,800 a year in total external costs. They take that $4,800, divide by 12, and they tack an extra $400 onto your monthly mortgage bill.
But the key word you just used there is guesses. They are estimating based on the previous year's reality. And this brings us to the annual adjustment.
Here we go.
Lenders are legally required to audit your escrow account every year to make sure they're collecting the correct amount.
And here is the answer to the mystery of why the payment jumps. Because if your local town council decides to raise property tax rates to fund a new school, or if the insurance market goes crazy because of severe weather and your premium skyrockets, that $4,800 estimate from last year is suddenly way too low.
Way too low.
So if your actual bills come in at, say, $6,000 for the year, your monthly payment absolutely must go up for the next 12 months to cover those new, higher real-world costs.
And it actually gets a little bit worse because this dynamic creates something called an escrow shortage.
A shortage?
Yeah. Not only do you have to pay a higher monthly amount going forward to cover the new rates, but you also owe the lender for the shortfall from the previous year.
Wait, seriously? I owe them back pay?
Yes, because they paid the higher tax bill on your behalf to protect the property, even though you hadn't contributed enough to the escrow tank to cover it.
Oh, man.
The tank went negative, they fronted the money, and now you have to pay them back.
Okay, so property taxes and insurance premiums are the ultimate culprits behind jumping payments. You can't control the weather, and you certainly can't control the town council's tax budget.
Unfortunately, no.
So, as a homeowner, what actionable steps can you take to manage these costs? Because you can't just absorb a massive financial jump without some kind of plan.
Well, when you were hit with an escrow shortage, the sources outline two distinct choices you have to resolve it, and it really just comes down to your personal cash flow management.
Okay, what's choice one?
Choice one is you can pay the entire shortage amount upfront to the lender in one single lump sum.
Which hurts. I mean, writing a check for $1,000 out of nowhere is a painful day.
It's incredibly painful. But the long-term benefit is that it keeps your monthly mortgage payment from spiking quite as high. You basically neutralize the past debt immediately, so your new monthly payment only increases enough to cover the new tax and insurance rates going forward.
Right, that makes sense. And choice two.
Choice two is to spread that shortage out over the next 12 months. The lender basically takes the $1,000 you owe them, divides it by 12, and adds that to your new, already higher monthly payment.
So it's easier right now, but you pay for it all year.
Exactly.
Yeah.
It's definitely easier on your immediate cash flow, but you are going to feel that extra weight every single month for a full year.
It makes me think about shock absorbers on a car. Like, you can't change the potholes in the road, meaning you can't stop your local government from hiking property taxes, but you can upgrade your car suspension so you don't feel the impact quite as much.
I love that analogy.
Part of that suspension is having a robust emergency fund to handle a lump sum payment. But the other part of that suspension is actively shopping for your homeowner's insurance.
Yes, absolutely. That is your primary lever of control as a homeowner. You can't shop around for property taxes, but insurance is a highly competitive open market.
Right.
Your rates are influenced by the home's value, your personal credit score, your location, and the specific level of coverage you select.
The sources spend quite a bit of time highlighting the danger of assuming a standard insurance policy covers everything. They explicitly warn that standard homeowners insurance does not cover wind or flood damage.
No, it usually doesn't.
So if you live anywhere near a high-risk area, or a hurricane zone, or a floodplain, these add-ons are crucial. I love the quote they use in the guide. They say, "The cost of flood insurance is a fraction of the potential loss it prevents."
It's the definition of a catastrophic risk.
Yeah.
I mean, a major flood doesn't just ruin the drywall or the carpets. It can fundamentally compromise the entire structural integrity of the asset.
Scary stuff.
Very. But getting that coverage right requires a proactive defense on your part. You cannot just buy an insurance policy at the closing table and forget about it for a decade.
Right. The sources heavily emphasize the need for an annual review of your policy. You need to pull it out, compare deductibles, check your coverage limits against current inflation, and actively get new quotes from different providers every single year to keep up with market trends.
That's the only way to stay ahead.
But realistically, beyond the annual calendar checkup, how is a homeowner supposed to know when it's absolutely critical to reassess their provider?
Basically, any major life change or upgrade to the property should immediately trigger a review.
Like an addition or something.
Exactly. Let's say you just put $50,000 into renovating your kitchen. You have drastically increased the replacement cost of your home. If your insurance policy limits aren't manually increased by you to match that new value, you are dangerously underinsured if there's a fire.
Oh, I hadn't thought of that.
Yeah. Or if local real estate values generally skyrocket in your neighborhood, the structure itself might cost far more in labor and materials to rebuild today than it did 5 years ago.
So you have to make sure the policy matches reality.
Right. You want to ensure you aren't overpaying month to month by staying loyal to an expensive provider, but you must ensure you have the coverage required to actually make you whole in a disaster.
So what does this all mean for you, the first-time buyer sitting across the desk from us? We've covered a massive amount of ground today.
We really have.
We started with the absolute necessity of gathering your W-2s and perfectly documenting your bank statements to keep the underwriter happy. We explored the strategic advantage of taking a spring tax refund, seasoning it in your account for 60 days, and deploying it specifically to absorb those shocking closing costs without draining your emergency fund.
Such a crucial step.
Then we pulled back the curtain on the ruthless mechanics of an escrow account, explaining exactly why a fixed-rate mortgage can still result in a jumping monthly payment. And we finished with a playbook for fighting back against those jumps by aggressively shopping your insurance and utilizing your emergency fund as a shock absorber against inevitable escrow shortages.
It is a vast amount of information to take in.
Yeah.
But understanding these underlying mechanics is what transforms you from a passive participant being dragged along by the bank to an active, confident manager of your own wealth.
Beautifully said.
And there's one final, slightly provocative thought I want to leave you with, synthesizing all these sources. There's an old saying in the real estate industry that the best time to buy a house is always 5 years ago.
Because of the assumption of property appreciation, right?
Because of appreciation, yes. But think about how your home functions as a living financial organism. When you sign that massive stack of paperwork and lock in your fixed-rate mortgage, your principal and interest payment is effectively frozen in time.
It's locked.
Right, it becomes a financial time capsule. While the rest of the world gets more expensive around you, while rent goes up and the cost of groceries goes up, that massive portion of your housing cost is actually fighting inflation for you.
But the escrow part of it.
The escrow is the part of the organism that is constantly adapting to the real world. Property taxes and insurance will always track with inflation, with climate risks, and with market reality.
That makes a lot of sense.
So the question for you to mull over as you build your savings and prepare for homeownership isn't just how to scrape together the down payment. It is how might you structure your personal emergency fund, not just for a broken water heater or a leaky roof, but to completely absorb those inevitable, evolving escrow adjustments over the next 30 years without ever feeling the financial squeeze.
That is a phenomenal question to take away, and it totally reframes how you look at a savings account. You really have to plan for the predictable unpredictability of the market.
Absolutely.
So keep digging into your finances, keep your documentation impeccably organized, and start building your network of trusted real estate professionals early on, because when you do finally sit down across that mahogany desk to sign the papers, you won't be in the dark. You'll know exactly how the machine works. Until next time.
That's it for today's Meet Sean. If this helped, follow the show and share this episode with one person who needs it. See you next time.